Transfer pricing doesn't just shape internal business decisions, it also has major tax implications, especially for multinational companies. In the U.S., the IRS taxes worldwide income, not just domestic earnings, a policy shared by countries like the UK and Japan. U.S.-based firms do get tax credits for foreign taxes paid, but there are limits. Sometimes this means a portion of foreign income gets taxed twice, once abroad and again when brought back to the U.S. It's tempting for companies to manipulate transfer prices to minimize taxes, but beware. Using transfer pricing schemes to shift taxable income illegally is a felony. Smart managers must balance tax efficiency with strict legal compliance to avoid severe penalties. Just how closely do authorities monitor transfer pricing? Consider these statistics. 80% of multinational organizations expect to face a transfer pricing audit within 2 years, a clear sign that scrutiny is rising worldwide. In fact, IRS challenges to transfer pricing allocations increased by 40% in just 6 months during 2008. To manage this risk, many companies seek advanced pricing agreements, or APAs, which set transfer pricing rules in advance with tax authorities. While APAs help avoid costly audits, they aren't cheap. Fees range from $22,500 to $50,000, and negotiations typically take about 20 months. These numbers highlight why careful documentation and proactive planning are essential for global businesses. When managers are tasked with setting transfer prices, they have 3 main options to consider: market-based, cost-based, and hybrid methods. Each approach has its own strengths and is suited to different business situations. Market-based transfer prices use the going rate in the open market as a benchmark, which can be especially useful when there's a competitive market for the product or service being transferred. Cost-based transfer prices, on the other hand, are determined by the actual costs incurred in producing the goods or services, which can help ensure that internal transactions reflect the company's true expenses. Hybrid methods blend elements of both, allowing for flexibility and adaptation to unique circumstances. But how do managers decide which method to use? The answer depends on factors like the competitiveness of the market, the company's internal cost structure, and strategic objectives. As we move forward, we'll take a closer look at each method, exploring when and why each is most appropriate. By understanding these options, managers can better align divisional incentives with overall company goals, maximizing both profitability and compliance. Let's take a deeper look at market-based transfer prices, which are often considered the gold standard when certain conditions are met. Transferring products or services at market prices generally leads to optimal decisions, but only if 3 important criteria are satisfied. First, the market for the intermediate product must be perfectly competitive. This means there are many buyers and sellers, and no single participant can influence the price. Prices are set purely by supply and demand. Second, the interdependencies between subunits or divisions should be minimal. When divisions operate independently, it's easier to evaluate their performance fairly and avoid conflicts of interest. Third, there should be no additional costs or benefits to the company as a whole from buying or selling in the external market instead of transacting internally. If these conditions are met, market-based transfer pricing encourages efficiency, transparency, and fair performance evaluation. It also helps ensure that divisional managers are motivated to make decisions that are in the best interest of the entire organization, not just their own unit. Now let's explore how transfer pricing works when markets aren't perfectly competitive. In these situations, selling prices directly influence the quantity of goods sold. For example, imagine a division within a company that produces an intermediate good, but faces only a few external buyers. Here, if we set the transfer price too high, matching the external market price, internal transfers might drop, reducing overall efficiency. To encourage more efficient transfers between divisions, managers typically set the transfer price below the external market price, yet still above the variable cost for the selling division. This strategy ensures the selling division covers its costs while promoting optimal use of resources company-wide. Striking this balance is crucial for aligning divisional incentives with the organization's broader goals. Let's talk about cost-based transfer prices, a popular choice when reliable market prices aren't available or practical. Think about cases where markets are imperfectly competitive, the product is highly specialized, or internal products differ in quality or service from what's sold externally. In these scenarios, top managers set transfer prices based on the actual costs of producing the intermediate good. They might use a full cost basis, which includes both fixed and variable costs, or a variable cost basis that only considers costs changing with production volume. This approach ensures that transfers reflect real production expenses, making it especially valuable when outside price benchmarks simply don't exist. It also helps companies maintain fairness and transparency across divisions. Why do managers often favor full cost-based transfer prices, even though they have some drawbacks? One reason is that full cost pricing represents all relevant costs for long-term decisions, not just what it takes to make one more unit, but also covering fixed overheads that keep the business running. This approach makes it easier to set external prices because both variable and fixed costs are already considered in the calculation. Plus, from an administrative perspective, full cost-based pricing is straightforward and less expensive to manage compared to more complex methods. So, while it isn't perfect, its practicality and ability to support strategic planning make it a go-to choice for many organizations. But using full-cost transfer pricing brings its own set of challenges. First, how should a company allocate indirect costs, like utilities or shared services, across different products or divisions? If these aren't assigned accurately, transfer prices can become distorted. Second, have we properly identified all relevant activities, cost pools, and allocation bases? Missing or misclassifying any of these can undermine the fairness and effectiveness of transfer pricing. Finally, there's the question of which fixed cost rates to use. Should we rely on actual historical costs or budgeted projections? Each option impacts divisional performance evaluation and decision-making differently. Addressing these issues is key to ensuring that full-cost transfer pricing supports sound management control. Hybrid transfer prices offer a flexible solution by blending both cost and market information. Imagine management setting a transfer price somewhere between the internal minimum, the cost to produce and deliver, and the external maximum, the going market rate for similar goods. This approach can be especially useful when neither pure market nor pure cost-based methods seem appropriate. There are several types of hybrid systems. Prorating the difference between maximum and minimum prices spreads benefits fairly. Negotiated pricing lets divisions bargain for a mutually acceptable figure. And dual pricing uses two separate methods for each side of a transaction. Each hybrid method aims to balance fairness, motivation, and economic efficiency within decentralized organizations. Negotiated transfer prices are perhaps the most dynamic form of hybrid pricing. Sometimes, divisions within a firm have the freedom to negotiate their own terms, deciding whether to trade internally or look outside the company. Interestingly, these negotiated prices might not reflect strict cost calculations or current market values at all. Instead, they result from direct bargaining between the selling and buying units. This method shines in volatile markets where prices shift rapidly, giving both sides flexibility to adapt as conditions change. Ultimately, negotiated transfer prices foster autonomy and collaboration between subunits, encouraging them to reach agreements that serve their best interests while supporting the company's broader strategy. Beyond negotiation, hybrid transfer pricing includes some creative alternatives like prorating and dual pricing methods. Prorating means splitting the difference between the highest allowable cost-based price and the lowest, helping both sides feel they've reached a fair deal. Dual pricing takes it a step further by assigning different transfer prices to each subunit. For instance, the selling division might record revenue at full cost, while the buying division records its purchase at market value. This approach can smooth out internal disputes and better align divisional incentives with company goals. By customizing transfer pricing strategies in this way, organizations can address unique business needs while keeping everyone motivated and accountable. Let's explore cost-based transfer prices, a foundational approach in many organizations. Here, the transfer price is set using some measure of cost, such as full absorption cost, variable cost, or fully loaded cost. Why might a company choose this method? For one, it's especially helpful when there are no reliable market prices available, like with unique, internally developed products. Cost-based pricing can also motivate outsourcing in the long run if external suppliers become more competitive. Importantly, if the selling division is treated as a cost center, this method tends to minimize internal conflicts. But there's a catch. Selling divisions might simply pass costs along without monitoring efficiency. That's why budgeted costs are sometimes used instead of actual costs, to encourage better cost control. Market-based transfer prices work differently. They use external market prices as the benchmark for internal transfers. This method assumes that reliable market prices exist, but what happens if they don't? Sometimes, companies adjust the transfer price to reflect savings from internal transfers, making it more attractive for both divisions. If a selling division has extra capacity, it might accept prices closer to its variable costs, potentially even below the market rate. However, using market-based prices can spark rivalry between divisions, especially if market prices temporarily drop, benefiting buying divisions at the expense of sellers. To smooth things out, some firms use average or normal prices over time. This approach is particularly effective when the selling division operates as a profit center, aligning divisional incentives with overall company goals. Negotiation-based transfer prices introduce another layer of complexity and autonomy. Instead of relying on cost formulas or market benchmarks, managers from each division sit down to negotiate the price. While this preserves divisional independence and allows for flexibility, it can also lead to challenges. Managers may hesitate to share information because the outcome directly impacts divisional profits. Think of it as a tug-of-war between teams. The final negotiated price might not reflect true market values or actual costs, and the process itself takes time and effort. Plus, whenever company conditions or leadership change, negotiations may need to be revisited. Despite these hurdles, negotiation-based pricing can be valuable in decentralized organizations that value autonomy and dynamic decision-making. How do companies actually use these transfer pricing methods in practice? A poll of Fortune 500 firms in 2010 reveals some fascinating trends. Domestically, nearly half, 46.2%, of firms relied on cost-based methods like variable or full-cost pricing. Internationally, this figure dropped slightly to 41.4%. Market-based pricing was more popular in cross-border transactions, used by about 46% of firms internationally compared to 37% domestically. Negotiated transfer pricing saw moderate use, around 17% domestically and about 13% internationally. These numbers highlight how companies adapt their approach depending on context. Choosing cost-based methods when markets are unclear or internal consistency matters, and favoring market-based pricing for international transactions where transparency and tax considerations are crucial. Let's dive deeper into why transfer pricing is such a critical accounting priority for managers, especially in multinational corporations. At its core, transfer pricing isn't just about setting prices for goods or services exchanged between divisions. It's a strategic tool that can dramatically influence a company's global tax obligations. Imagine a parent company with subsidiaries in several countries, each with different tax rates. By carefully choosing transfer pricing methods, managers can shift profits from high-tax jurisdictions to those with lower tax rates, effectively reducing the company's overall tax bill. This isn't just a theoretical benefit. In practice, the sums involved can be enormous, sometimes amounting to millions or even billions of dollars in tax savings. That's why transfer pricing is not just an accounting detail, but a central part of global business strategy. Managers must balance the need for compliance with local tax laws and the desire to maximize after-tax profits. The methods they choose, whether cost-based, market-based, or negotiated, can have far-reaching implications for the company's financial health and competitive position worldwide. Transfer pricing's impact extends far beyond just income taxes. It's a powerful lever that can affect a wide range of tax liabilities for multinational companies. When managers set transfer prices, they're not only influencing how much income tax the company pays, but also shaping payroll taxes, customs tariffs, sales taxes, value-added taxes, and even environment-related taxes. For example, a higher transfer price on goods shipped from one country to another could increase customs duties, while a lower price might reduce sales tax obligations in the receiving country. This complexity means that tax factors, especially income taxes, are always top of mind for managers when determining transfer prices. They must carefully analyze the tax regulations in every country where they operate, balancing the need to minimize the company's total tax burden with the requirement to comply with local and international laws. Ultimately, effective transfer pricing strategies can help companies remain competitive, avoid costly penalties, and ensure that their global operations are as tax efficient as possible. Tax authorities closely monitor how multinational firms use transfer pricing, and for good reason. The IRS taxes U.S.-based companies on worldwide income, not just domestic earnings. Similar rules apply for UK and Japanese firms. To avoid double taxation, U.S. domiciled companies receive credits for foreign taxes paid, but these credits are limited. Sometimes this means income earned abroad gets taxed twice when profits are repatriated from high-tax countries. Crucially, manipulating taxable income through improper transfer pricing schemes is illegal and considered a felony offense. For students entering the accounting profession, understanding these legal boundaries is essential to responsible practice. Let's look at some real-world statistics about transfer pricing, enforcement, and risk. According to a global survey by Ernst & Young involving over 580 multinationals in 9 countries, a staggering 80% expected to face a transfer pricing examination within 2 years. The IRS has stepped up its scrutiny too, with challenges to transfer pricing allocations in federal court rising by 40% in just 6 months during 2008. To help manage this risk, many companies pursue advanced pricing agreements, APAs, which set acceptable pricing methods ahead of time with tax authorities. Although APAs involve significant costs, ranging from $2,500 to $50,000, and typically take around 20 months to finalize, they can provide valuable certainty and peace of mind for global businesses navigating complex regulations.